Inflation, interest rates, trade wars, the world is a mess right now. And so is the stock market. But here's the thing. In moments like this, stocks, even with a strong balance sheet, drop to their 52-week low valuation, ultimately trading at extreme discounts. Today, I'm showing you and John 5 dividend-paying stocks that are currently trading at or near their 52-week lows. We'll look at what's behind the dip, why Wall Street is short-sighted, and how these stocks could turn a simple $10,000 investment into over $1 million. In the end, I'll show you one of the best discounted stocks that has the potential to turn a $10,000 investment into a $2.8 million portfolio that pays over $50,000 in annual dividend income. Now, before we get into the list, let's quickly talk about how these stocks were chosen. Each one of these stocks lost value recently, not because the business is falling apart, but because the market's reacting to short-term economic conditions, political tension, and trade wars. That's key. These companies still have strong fundamentals, consistent earnings, and proven resilience through economic cycles. I specifically looked for dividend payers with a long history of increasing payouts because that kind of consistency signals smart capital allocation and long-term stability. Just as important, every stock here combines income with growth. It's not just about the dividend, it's also about total return. So let's start at number 5 with a stock you probably know but might not expect: United Health Group, with ticker symbol UNH. So far this year, the stock is down 16.47%. That's a pretty big drop, especially for a company this solid. But here's the thing. When a giant like this stumbles, it doesn't usually mean the business is falling apart. It just means the price tag got a little friendlier. And for long-term investors, that kind of dip isn't scary. It's exciting because when a strong company takes a step back, that's often the best time to lean in. So what's going on? This price drop is mainly driven by fears around Medicare Advantage reimbursement cuts and increased regulatory pressure. A recent Centers for Medicare and Medicaid Services announcement signaled a potential squeeze on insurer margins for 2025, and that hit big players like United Health. Plus, let's not forget the hacking incident earlier this year involving their subsidiary Change Healthcare, which disrupted pharmacy services nationwide and exposed vulnerabilities in their tech infrastructure. All this has spooked short-term investors. Despite all this, it massively grew and got close to its all-time high, only to be hit by recent economic conditions. But here's where things get really interesting. Despite this turbulence, United Health is growing. In fact, they reported $109.57 billion in revenue for Q1 in 2025 alone, with a profit of $6.29 billion. That's over a 9% year-over-year increase in revenue. So while the media headlines scream crisis, the earnings statements clearly show opportunity. Right now, United Health has a dividend yield of 1.85%. Not the biggest out there, but don't let that fool you. This is a grower, not just a payer. Over the last 10 years, United Health has increased its dividend by nearly 18.8% per year, doubling it about every 4 to 5 years. And the stock? It's averaged a solid 14.37% return annually. So while the income starts small, it's built to grow, and that's where the magic happens. It's also worth noting United Health has one of the most consistent dividend growth streaks in the healthcare sector. They've raised their dividend for 13 consecutive years, and they have a payout ratio that leaves plenty of room for future increases. Based on these metrics, let's say John invests $10,000 in this stock. Here's how it would look. After 1 year, his portfolio would be worth $11,622. After 10 years, his investment would grow to $46,592. After 20 years, his portfolio would be worth $241,071. But here's the magic of compounding. After 30 years, reinvested dividends would help grow that into $1,463,082. Meanwhile, paying around $78,713 in annual dividends, or about $6,559 in monthly dividend income. The total value added to John's portfolio will be $1,453,082. Of that, $393,139 would come from dividends alone, and capital appreciation would contribute $1,059,943. Coming in at number 4 is Pool Corporation with the ticker symbol POOL. Right now, Pool Corp is trading nearly 10% below year to date. And yeah, when you first hear the name, you might think, pool supplies? Really? But this isn't some tiny backyard business. Pool Corp is actually the biggest distributor of swimming pool equipment and outdoor living products in the world. If you've seen a pool in someone's yard, there's a good chance this company had something to do with it. So why the drop? Well, the slowdown in housing and home improvement has a lot to do with it. With interest rates still high, homeowners are holding back on luxury upgrades like pools, decks, and backyard transformations. Add to that a series of weak quarterly outlooks in 2024 due to softer demand in construction, and investors started hitting the brakes. But they are still making money. They're expecting to pull in over $6 billion this year, and their profit margins are still solid. A big reason why? They've built a smart business around not just building pools, but keeping them running. Chemicals, parts, repairs, stuff people need every year no matter what the economy's doing. Now for the dividend. The current yield sits at 1.57%. Doesn't sound like much, but over the past 10 years, they've grown that payout by 18.49% a year. On top of that, it has an average share price appreciation of 16.09%. And if someone like John put in $10,000 in reinvested dividends, here's what the future projections would look like. After 1 year, his portfolio would be worth $11,766. Give it 10 years, and he'd be looking at $51,637. After 20 years, it would be valued at $277,428. After 30 years, the same 10 grand could grow into more than a $1.5 million portfolio, paying around $41,055 in annual dividends, or about $3,421 in monthly dividend income. In total, John's $10,000 would grow into a massive $1,557,088. Out of that, around $229,556 would be pure dividend income, while $1,327,532 would come from the stock climbing higher over time. Now, these are solid returns, but there are even better options to come. And in the end, I'll show you one of the best discounted stocks that has the potential to turn a $10,000 investment into a $2.8 million portfolio that pays over $50,000 in annual dividend income. Coming in at number 3 is D.R. Horton with the ticker symbol DHI. The stock is down about 10.6% year to date, which might seem like bad news, but for long-term investors, it could actually be a pretty interesting setup. They've built a name by doing exactly what most people said couldn't be done profitably: building homes for middle-income families at scale. And for years, they nailed it. But recently, not so much. The reason for the recent dip is no mystery: interest rates. The Federal Reserve has kept borrowing costs high to cool inflation, and the housing market felt that chill hard. Mortgage rates hovering around 7% have scared off a good chunk of first-time buyers, which naturally hits builders like DHI right in the revenue. On top of that, input costs like lumber, labor, and land haven't come down as much as expected. It's a bit of a tight squeeze, especially for companies like D.R. Horton that operate in the more affordable housing segment where margins can be thinner. But here's the thing, DHI knows how to adapt. Despite all of these challenges, the company still pulled off an impressive $7.7 billion in revenue in Q1 of 2025. And their net income came in at $810 million. Not too bad for a company everyone thought would get steamrolled by interest rates. The truth is, housing demand is still there. It's just paused. People still need homes. Millennials and Gen Z are aging into home ownership, but housing inventory is low, and once rates cool off, demand will likely come roaring back. And D.R. Horton has the scale, the land, and the experience to be ready when that happens. D.R. Horton's dividend yield is 1.32%, but don't let that low number fool you. With a 21.48% dividend growth rate and 15.77% average returns, this stock rewards big time. Now let's go back to John. If he put $10,000 into DHI and reinvested every dividend, he'd be looking at $11,709 after just 1 year. Give it 10 years and that grows to $50,103. After 20 years, it'll be valued at $279,611. And after 30 years, the portfolio would reach a massive $1,877,700. At that time, it'll be paying around $101,361 in annual dividend income, or about $8,447 in monthly dividend income. The total value added to John's portfolio will be $1,867,700. Of that, $464,365 would come from dividends alone, and capital appreciation would contribute $1,403,335. Now from homes to steel. Taking the number 2 spot on our list is Steel Dynamics with the ticker symbol STLD. It's currently trading about 2.35% in green. Steel stocks are known for being a bit of a roller coaster. Prices bounce around, demands shift fast, and political politics always seem to be in the mix. But here's what makes STLD different. It doesn't just ride the waves, it profits from them. So why the recent dip? Well, it's mostly due to falling steel prices and growing concerns about a global slowdown. China's demand has softened, especially in construction and manufacturing, and when China slows down, it tends to shake the whole steel market. Add in worries about slower car and appliance production in the United States, and it's easy to see why investors hit pause. But for dividend investors, this might be the sweet spot. STLD currently has a dividend yield of 1.69%. They've been growing that payout by about 14.6% a year, and they've been raising it consistently for over a decade. On top of that, their average annual return on the stock itself is an impressive 18.94%. That's the second best performance on today's list. It's rare to see numbers like that in the materials sector, but STLD makes it look easy. And now let's check back in with John. If he invests $10,000 into STLD and reinvests his dividends, he'd see it grow to $12,063 in just 1 year. After 10 years, it would be $63,660. After 20 years, it'll be valued at around $388,658. And if he stuck with it for 30 years, that same investment will reach $2,310,023. The total value added to John's portfolio will be $2,300,023, of which around $70,000 would come from reinvested dividends and the rest, over $2.2 million, from the stock's growth. And finally, taking the number 1 spot on our list is a company you probably won't hear mentioned on CNBC, but it's been quietly delivering for decades. It is UFP Industries, with the ticker symbol UFPI. Despite having solid numbers and a business that runs like a well-oiled machine, this stock is currently down about 6% year-to-date. UFPI works in the world of wood, packaging, and building materials, not the flashiest space, but incredibly important. Whether it's for home construction, industrial shipping, or protecting products in transit, UFPI plays a part in it. If something needs to be built or moved, odds are UFPI is involved. So why is the stock down? Well, it comes down to a mix of short-term market fear, interest rate pressure, and a general cool-down in housing-related demand. Rising mortgage rates have hit home construction, remodeling, and retail lumber sales. And as those slowed down, so did Wall Street's enthusiasm for suppliers like UFPI. There was also a slight miss in volume growth during the last earnings cycle, particularly in their retail and construction segments, which make up a large chunk of revenue. But here's the key. UFPI's profitability hasn't gone anywhere. And here's what makes UFPI different. They're still making it work. In its most recent quarterly reports, it brought in $1.46 billion in revenue and kept good profit margins across nearly every part of the business. Not only that, they beat earnings expectations again. And when it comes to dividends, UFPI currently sports a 1.34% dividend yield, which aligns with some of the others on this list. But the secret weapon, it has a 20.75% dividend CAGR over the last decade. That's the fastest growing dividend on this entire list. And the share price? That's been climbing too, up about 19% annually on average. When you mix that kind of growth with fast-rising dividends, it is a powerful combo. So, what does this look like in real terms? Well, let's say John puts $10,000 into UFPI and reinvests dividends. After 1 year, he'll see his portfolio grow to $12,034. By year 10, his portfolio grows to $64,282, and by year 20, he would be holding $422,742. But wait for it. By year 30, that same $10,000 becomes $2,856,296, paying $52,221 in annual dividend income, or about $4,352 in monthly dividend income. The total value added to John's portfolio will be $2,846,296. Of that, $277,253 would come from dividends alone, and capital appreciation would contribute $2,569,043. Don't have $100,000 in savings? No worries. Click the video on the screen to discover 3 dividend stocks that can surpass your full-time job with just a $50 a week investment strategy.